Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. Things seem to be a little bit more normal in the financial markets than they were before we last spoke. I was about to say they seem more normal, but I can't say that about the entire world, but we're just talking about the financial markets.
Yes, the equity markets, how much have they come back after their lowest point, after the big drop with all the virus news?
Well, the S&P 500 fell to 2,200 and has rallied up to 2724, and that's a rally of about 23%. The thing about that is when the market fell over 20%, actually fell over 30%, I heard people on television say, oh, now we're in a bear market because we've fallen over 20%. They think that means you're in a bear market. And then soon afterwards, once it began to go back up a little bit, I then heard them say, well, now we're in a new bull market. And that just shows you how just looking at, these moves up and down, it can shake you out. It doesn't really necessarily tell you anything. What does matter is the big trend of the market. And the simplest way to measure that is whether something's above the 200-day moving average or below it. When you're above it, that moving average acts as support in a bull market. And when the market's below it, it tends to act as resistance. And the S&P, the Dow, the NASDAQ are still well below their 200-day moving averages, even with this bounce. The S&P is around 2724, but the 200-day moving average is around 3,000. And that tells me that we're not in a bull market, even with this move, even with the claims of people that we are in a new one. I just think that's really unrealistic. However, when new bear markets begin, the first rally, typically this is what you see. People say, well, we're just going back to normal and the market is going to price that in. That's what happened in the summer of 2000, and also the summer of 2008. And I was trading during both those times. So to me, the psychology behind what is going on in the mainstream media and also among individual investors is classic of early in a bear market where people get captivated by the first rally. In fact, if you go to Google Trends, it's a thing Google has that shows you how many times a month people type in various search keywords, and they'll show you the history of this. Well, in the past few weeks, there has been a complete surge in people typing in bull market and how to buy stocks. In fact, more now than ever before. So that tells me that the public, at least when it comes to the stock market, that now they're very bullish and they are thinking things are going to go back to normal. But, I think people need to be cautious, to say the least. It doesn't mean I think the market's about to go straight back down, because typically when you do have a bear market rally, the market goes up fast in a couple weeks, then just kind of the momentum fades out and you just tend to go sideways for several weeks, even several months. So as those examples of the summer 2000, there was a bear market. The first bear market rally was from April to Labor Day. And in 2008, there's one from about January to June that took place. That was the bottom and the peak. So, those were things that took several months to play out. but almost all the gains came in the first couple of weeks. I think that's where we are now. So I think that means trading the averages themselves at this point, I don't think there's really much immediate upside or immediate downside. So very little profit potential from a trading perspective. So that forces people to look either at individual stocks or frankly something besides the stock market. And I think that's really what people should be doing, looking for something else besides the S&P 500.
Where can you look outside the stock market right now?
Well, I think the best thing people should be buying, frankly, is gold. Gold is still above its 200-day moving average. In fact, gold is close to making a new 52-week high. So it's not only just above the 200-day moving average. And more importantly, gold has been outperforming the stock market since October of 2019, and that outperformance is only growing. So you can measure this by looking at the gold divided by S&P 500 ratio, comparing the price performance of both. And that ratio began to surge in February before the drop in the stock market happened, and gold did pull back from about 1,700 in March to 1,450 in like a week, and now just almost made a new high. But that drop happened during that week in which there really was a financial crisis in the United States, or we were on the verge of one. Bond funds are beginning to malfunction. They're diverging from their net asset value. And in the Federal Reserve, began these quantitative easing. They lowered rates to zero and 3 times increased their quantitative easing buying operations until the final time in which they basically said, we're now on unlimited bond buying. But during that period of time where they were stepping up these QE operations, we were seeing the verge of a financial meltdown that was dragging down everything in the financial markets. And that's when gold took a little bit of a hit really quickly, but it's recovered completely. And the same thing happened with mining stocks. The GDX ETF made a high of 32, or right below 32 in February, fell all the way down to 17, and now it's right back to the 200-day moving average. Whereas the U.S. stock market is still over almost 15% below the 200-day moving average, GDX is right on it, complete recovery. This is the difference between gold stocks and the price of gold and the S&P 500. And really, I think part of what drug GDX down in 2 days, it fell from 23 to 16, was some sort of malfunction in the gold stock ETFs. JNUG blew up, completely diverged away from its net asset value. That's a triple ETF designed to go up 3 times and down 3 times the price of gold. And that ETF malfunctioned so badly that the company that operates it has changed it from being a 3 times ETF to now a 2 times ETF. So when it comes to gold stocks, 3 times ETFs are all destroyed. And I know I've said several times on your show, and other guests have, to avoid these ETFs because they are designed to lose value over time. It's just because they use these derivatives that fade in value, and they're just dangerous. And what happened in March proved that, and now they no longer exist as 3 times ETFs. They're 2 times ETFs. But even 2 times ETFs, just to me, make no sense as an investment perspective when you can get better gains you think you're getting there with less risk in small cap mining stocks. And when it comes to small cap mining stocks, interestingly enough, they did pull back in February and March, but they didn't get smashed like JNUG and these 3 times ETFs did. And since March to now, all these stocks, for the most part, have stabilized and have begun to turn up this week. So I think I think this is a great buying time right now for mining stocks, big cap, small cap, across the board, and for people to put gold as a core position in their accounts. In my view, most Americans are trained to invest a portion of their money in the stock market, a portion of their money in the bond market, and that investment strategy, I think, must incorporate gold, because the bond market has no real value anymore when interest rates are zero, and the only buyer or the biggest buyer is now the Federal Reserve, because there's not enough real people willing to put up money and get less than 1% on Treasury bonds holding for 10 years. And in junk bonds, corporate bonds, they peaked out in February. I believe they're starting a bear market. So bond funds just don't make good sense as safe havens anymore, in my view, and that's why I think it's just another reason that people must get involved in the gold market, at least for the next decade. It's just, I think, likely to outperform the stock market. In 2000, when the market had the internet bubble bust, gold outperformed for 12 years the Dow and the S&P 500, and I think we're started a similar moment 2 years ago in which gold is simply going to outperform for the rest of this decade.
We'll have more with Mike Swanson right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Mike Swanson. Mike, if people are going to get into gold, should it be gold certificates, physical gold, ETFs, mining stock? Do you have any preferences?
Well, the easiest thing to do is just buy metals ETFs. So, for example, GLD, there's a Central Fund of Canada, because they really aren't that volatile. In fact, the funny thing about it is the drop that happened in March, these ETFs did decline, but they declined less than the S&P 500 did, and they've come back. So in my view, gold is now less volatile than the stock market with more upside. So I think it's the simplest thing for anyone to do. I don't really know much about gold certificates. Physical gold is also a good thing to get involved in, but you got to have a place to store it, which may be a drawback. But one good thing about it is if you buy physical gold and you get a safety deposit box or something, you're less likely to sell it on a whim because of a daily move in the market, which is one of the biggest problems anyone has if they buy something that's in a bull market, is getting shaken out on any pullback. So a nice thing about physical gold is you're less likely to get shaken out. However, the mining stocks do have more upside, but they have more volatility and more risk. And that's magnified even more with the small caps. They have, the right ones have more upside potential, but there's more risk in them because they're small cap stocks. And the most risky thing is the 2 times ETFs now, because yes, they can go up, but they also are designed to erode in value almost no matter what happens. So you got to be like a day trader. But gold stocks, I like them, but I own them. I'm involved in small cap mining stocks. I know most of your listeners are too. But I think the people that buy them, they have to be willing to do some homework to pick out the best ones, or find people willing to do that. They have to be more on top of their accounts, and so forth. So the average person, you may not be willing to do that kind of work. But that's the average person. That's not, I don't think that's your audience. Your audience is much more sophisticated than the average investor.
Yeah, I was going to say they don't mind taking a helicopter ride out to the mine site to check stuff out.
Yeah, exactly. But one thing about it, we're in an interesting moment with the mining stocks too, because most of them are having the same problems every other business in the world just about is having, and that's they're being disrupted by shutdowns of this by travel, the coronavirus, and on and on. So a lot of the mining operations are being suspended, exploration activities being suspended. So it's kind of interesting. It makes it so. Yeah, it's just weird. I mean, the earnings are probably going to be flat, and there's not huge news flow coming out of small cap companies probably for the next couple months. Maybe that creates an opportunity for people to take advantage of, but it is a strange time, to say the least.
We'll have more with Mike Swanson right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, are people trying to look for a pharmaceutical company to invest in, or companies with the hunt on to find a vaccine or a cure for this virus?
Yeah, some people are doing that. For example, a friend of mine, he's bought into this thing called AmerisourceBergen that's supposed to have a device that can do a lot of testing fast, to give you a test result in 15 minutes. But I don't really believe there's one company that is going to create this one test that's going to take over the entire world or the entire testing market. And as far as vaccines go, I have no idea what company the vaccine first, much less what country is going to develop the vaccine first. So I'm really not the person to ask to pick out which stock to buy when it comes to that. I'm not even trying. But, I'm going to stick to the mining world where I think there's even less speculation and try to pick out which one's going to have the wonder drug.
Yeah, the reason I wasn't asking so much is what company, but, were people just doing that?
They are for sure.
Yeah.
They are for sure.
Well, it's like betting on that long shot at the track.
Yeah. But but it's even, for me, it's even harder because at least I would have a guide to know which of 10 horses to pick out. And it's kind of more fun, watch them run or something, whereas biotech companies are strange animals.
On the energy front, is there any hope for the oil patch right now?
Well, the energy world is something I'm really interested in buying at some point. I actually bought energy stocks in January, and then got stopped out of them as they fell through my stop loss orders. But I want to try to buy back in at some point, but it's probably going to be a while before I do that. It's quite amazing how much energy fell, from over to about 65, touching below 20. Incredible. But typically, if a commodity falls like that, and it's fallen way below its 200-day moving average too, it takes quite months, if not a year, to build a base, to launch a new bull market off of. So I think we're probably at least a year away from oil taking off, maybe even, well, I'm not going to say 2 years, but probably a year away. But I do think there's going to be great value in that. And that's one thing about the S&P 500 and the Apple and the Facebooks, all these popular stocks that so many people are, in the United States at least, are just trying to jump back in. There's better opportunities elsewhere. I mean, I've spent a lot of time talking about gold, but from an investment standpoint, oil and energy stocks is a much better investment for the next 10 years than Facebook, Amazon, Google, S&P 500, because oil and energy stocks have collapsed, even worse than the U.S. stock market, and they're not going crazy in this recent rally. And I think will benefit over the next 10 years, even if the U.S. stock market is in a bear market. Energy and these energy stocks are likely to start a new bull market first and do well over the next 10 years. Because I think one of the big stories is going to be inflation, a weak U.S. dollar as a result of all these quantitative easing, zero rate policies. So I think from a financial standpoint, we're looking at some sort of repeat of the decade of 2000 to 2008, in which gold and commodities did great. Energy did great too, although energy didn't get going till like 2003, about 2 years after gold did. And also maybe the 1970s is another thing to think about too, because there was a lot of inflation in the 1970s, but we're in this economic recession or depression, really in the United States and the whole world, where everything is shut down for the most part. And the GDP projections are for a huge decline in the first 6 months of this year. We have over 20% unemployment. So we're in some sort of deflationary depression. But I don't think that's a permanent condition. And it's just going to be a prelude to an inflation boom. And that will benefit oil. It's going to benefit agriculture commodities across the board. But it's probably not going to start for another 12 months or so. But I do think, for sure, there's going to be great opportunities in energy. In some ways, I really, the mining stocks and gold, silver, they're my favorite investments for the next 10 years. But as far as like getting dividends and buying big cap stocks, there's only a dozen or so great big cap mining stocks, but with energy, there's going to be 100 or more. So it's something really to keep our eye on for sure.
Mike, with the reduced demand for oil and gasoline, has that affected electric car stocks like Tesla?
Oh yeah, for sure. Tesla was a wild stock, because it went from $350 in December straight up to $950 in February. And I think we talked about it when that happened, because it reminded me of something several internet stocks did in January, February 2000, right into the top of the NASDAQ back then. And at one point in 4 weeks, January, February, as this crazy move was happening, Tesla became the top traded stock on Robinhood by small account holders in the United States. They were trading that stock more than any. So many people were mesmerized by it, and now the stock's, fall. It fell to 350, and it's bouncing with the stock market. But yeah, it's affecting their sales for sure of cars, and also, they've had to shut down production. So and even more importantly, the debt market, the corporate bond market, is running into some problems when the market was melting down in March. So if these problems return, or we just have a bear market in bonds, Tesla is a company I would suggest is going to have trouble financing its debt, one that could go bankrupt or is likely to go bankrupt. So it's going to be fascinating to see what happens with the Tesla story as we go forward here.
Mike, thank you so much for chatting with us.
Yeah, great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HouseStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.